It's time for Yahoo Finance's Market Minute. Stocks are jumping on hopes that President Trump is softening his tariff approach. Tech stocks leading a lot of this morning's gains. You got Meta, Nvidia, and AMD getting a boost from those tariff hopes, as well as a new AI breakthrough from Jack Ma's Ant Group. Crypto-related stocks, Coinbase, Strategy, and Robinhood jumping as Bitcoin climbs amid the broader market rally this morning. The token marching toward that 90,000 level once again as spot Bitcoin ETF snapped their 5-week outflow streak last week. That's according to CoinShares. And Supermicro Computer downgraded this morning from Goldman Sachs. The analyst cutting SMCI to sell from neutral, trimming the price target as well to 32, down from 40, citing downgrade risks to valuation, competition, and gross margins. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, we're going to discuss how investors could use recent market volatility to buy the dip on certain sectors. And President Trump says the Small Business Administration will handle federal student loans after signing an executive order to wind down operations at the Department of Education. We discuss how this might work with a panel of experts. Plus, all this week, Wealth will be discussing spring cleaning your finances. We dig into different areas of your financial life, your budget, your investments, your debt strategies, in order to get you on a good financial path for the rest of the year. All that and much more coming up during today's hour. But first, we take a look at some of the market action as we always do. We're 90 minutes into the trading day. Take a look at this green on the screen that we've got for you. Stocks rising to start the week, boosted by some tariff optimism as the S&P 500 looks to snap its 4-week losing streak. Joining me now, we've got Adam Coons, Winthrop Capital Chief Investment Officer. Adam, good to have you here. And we mentioned tariff optimism. Perhaps it's a little bit more relief that it's not as wide-ranging as originally expected at the outlay. So how is your investment strategy changing as you navigate some of that recent volatility?
Well, this feels a lot like last year when there was all that focus on the Fed and what they were going to do, and markets were up and down and big waves on, kind of the crystal ball method of investing. And so for us, we came into this year definitely cautious, not because of tariffs, but just because of the increasing number of uncertainties that we knew were going to hit the market. So that's one thing that Wall Street hates more than anything. They hate it more than bad news. That's uncertainty, because they just don't know how to position. So you see risk premium going up. That's why you've seen this decline, because there hasn't been a real fundamental change, right? This year, we haven't seen a big drop in earnings or anything like that that would drive stocks down as much as they are, particularly in the tech space. So when we came this year, we were more defensive, and so that has given us a little bit of dry powder right now. And so for us, this means that we have the ability to add. And so that's what we're doing, where we're underweight some of these different names that have really been beaten up. We're incrementally adding because we know we're not going to time it. So we're just trying to pick our spots.
And so where are you allocating capital right now then?
Yeah, so like I said, coming into this year, we were overweight to healthcare. We were overweight to lower beta, high dividend stocks. And so we're starting to shift away from that. And last week, we were adding to NVIDIA on weakness. And so, like I said, we were underweight NVIDIA coming into the year. That's worked for us in this small time frame. And so, like I said, that gives us the ability to add. So definitely in kind of the higher quality tech names where, like I said, the fundamentals haven't changed. This is more just kind of that narrative-based decline in the market. So that's where we're putting our money right now.
What is the best kind of rule of thumb that investors out there should be using to identify what a valid versus an invalid dip buying opportunity might look like?
Well, look, I think like I said, timing the market is extremely difficult, and we don't recommend it. I think what you want to look at is, okay, what is my risk tolerance? where am I underexposed? Where am I underallocated? Maybe where I've missed out previously, and starting to add there. But you don't want to go all in. You really want to start to kind of piece your way in. You may miss it on the upside, and that's okay. But there may be more downside. So a lot, like I said, the crystal ball method of investing rarely works. So I think really just having your buy list, knowing those companies that are fundamentally haven't changed. Now, if something's changed fundamentally, that's a different story. But in this case, where the fundamentals haven't changed, like I said, earnings, revenue, those things haven't shifted away from your thesis, you should be adding here when you're seeing the dip, because no matter what, even if you don't time it perfectly, the reality is we will come out of this, we will recover, and you'll be happy that you added to those names that you really believed in.
I was taking a look at a note that hit my inbox this morning from BlackRock talking about bright spots in global stocks here. And we've continued to hear at the start of this year about the U.S. exceptionalism trade, and then some of the mindset, especially as tariffs started to emerge and the tit for tat that surrounds that, it started to be more of a global stocks picture. So I wonder how you're kind of threading the needle in your own allocations as well, and your own positioning.
Yeah, I mean, look, the U.S. markets have been the place to be for several years, and this is the first year we've seen a dramatic change in that. So I think you have to start to ask all of those questions. Is this a short-term reversal, or is this something that's going to last more long-term? And so we do divide the markets up. I think when you look at Europe and Japan, and when you're looking at those large developed countries that have outperformed, I just have to argue nothing. Once again, look at the fundamentals. What has structurally changed? And right now, there really isn't enough that structurally changed for me to say that this outperformance is justified. Now, when you look at China, and I think some of the shifts you're seeing there, that's where we're allocating more of our global allocation dollars, because that is a viable competitor to the U.S. here in the next 5 to 10 years, and so you're going to see more volatility out of a market like that. But we do see that as when you're looking at the global landscape, where are the opportunities for us? It's very bifurcated, and we see it really landing with the U.S. still and China long term. So those are where we're overweight, and then absolutely underweight when you're looking at Europe and Japan.
Adam, thanks so much for taking the time here with us today. Really appreciate the breakdown.
Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now is my Morning Brief co-host, Madison Mills. Maddie, we got to talk about United first here.
Yeah.
United Airlines is rising this morning. They've announced they're raising the annual fees for the co-branded Chase credit cards and yearly lounge passes. In the past, lounge passes, they ranged from $550 to $650 annually, depending upon your loyalty status. And they included unlimited visits to United clubs, entry for 2 guests, and access to other participating lounges. Now, United has introduced 2 options: an individual unlimited entry plan at $750 annually, and an annual all-access membership that covers 2 guests and entry to partner lounges for $1,400. And that's not to mention the price hikes for each of these airlines' credit cards with Chase. You can see the changes on your screen there below. Okay. So now that we boil all of this down, this is, in recent years, just one of the newest changes that's come forward on the card side. Of course, there was a little bit of chagrin that customers of Delta had a couple years back. They then reversed course, and ultimately there's been a lot of focus on how all of these airlines can add even more for the premium flyer and passenger out there.
I think it's just the latest example that flying keeps getting worse, and it's really hard to train consumers to expect less when we've gotten used to more, and that's exactly what you're getting when it comes to these lounges here. You are going to have to pay more for less, essentially, and this is after a slew of other airlines doing the same thing. We've seen JetBlue catering to the higher income consumer. We've seen Southwest getting rid of some of the features that their guests know and love here, and I think it's all in reaction to the profit margin pressure that we have seen off the back of lowered business travel, which we know, and you've covered this so much, Brad, this is the primary driver of revenue, the biggest revenue driver for a lot of these airlines. Business travel has not roared back post-pandemic the way that many airlines might have previously thought, and now they have to appease their shareholders with some way of increasing revenue, and they're looking at the everyday consumer.
No, it's a great point. I mean, one of the airline's biggest competitors out there is a non-airline company called Zoom. And so if you have enough people that are able to just have, and of course, there's still, the amount of business travel is not nearly rebounded to what it was, but there's still a considerable amount of those profits, to your point, that they rely on those business travelers for, knowing that there is a more propensity to spend usually from those corporate travelers as well, especially when you're just putting it on the company. Another ticker that we're looking at this morning, we got to check in on Pinterest. How's your Pinterest board looking? Getting an upgrade to buy from neutral at Guggenheim. The analyst says they expect monetization of the user base to grow at above market rates from 2025 to 2027, fueled by growth volume and AI ad improvements. Now, the firm also says the recent decline in share price is a good buying opportunity. Shares are up by about 5% right now.
I mean, this is fascinating. They obviously talk about the fact that the company's valuation is attractive right now. There's been a huge leave from the stock. We've seen a lot of selling, and they know a lot of potential growth catalysts here, right? They say the company is at record highs on engagement per user. Gen Z is 40% of platform usage on Pinterest. I find that fascinating. I think it's part of this shift of Pinterest being kind of the new storefront for shoppers online when you're not shopping in stores. Where do you go to get insight into the fashion trends and what clothes you might want to buy and what other kinds of products you might want to buy? You're going to Pinterest. They also talk about how because of that, they're seeing a lot of opportunity when it comes to ad market revenue here, performance-based advertiser exposure accounting for 2/3 of their revenue. That puts them at an advantage compared to some other competitors in the space here. And they also just lastly talk about, of course, some of the AI tools that will be at their disposal, both for ad performance and also on platform as well.
My dad made fun of one of my Pinterest boards one time, and I haven't returned.
You showed your dad your Pinterest board?
I showed him one time, and
what was it?
Oh, it
was it basketball?
No,
Sports?
it was all of the shipping container homes. Just a compilation of shipping container homes. I don't know why I was so into it. Still kind of am, but it was remarkable what they could do.
Parents, remember, express interest.
Yes.
That was an emotional call at the time.
It was.
Feedback.
Thanks, Dad. Maddie,
love the dads.
appreciate you. Thank you so much. Coming up on the other side of the break, everybody, we discuss the declines in leveraged ETFs. And if you don't know what those are, we're going to define the term for you. Plus, later on in the show, we discuss spring cleaning your finances, how to declutter your budget as we head into the second quarter of the year. Leveraged ETFs gained popularity in 2024 with assets under management in leveraged ETFs jumping 51% to $134 billion in the 12 months ending January 31st, according to Morningstar. Now, some of the most popular leveraged funds have wiped out most of their gains to start 2025. So what do investors need to know about the leveraged ETF trade? Joining me now, we've got Kristen Myers, ETF.com Senior Vice President of Content and Editor-in-Chief of ETF.com. Kristen, great to see you, and thanks for hopping on the program with us. Can we just let's set the scene here by explaining what leveraged ETFs are? What do people need to know?
Okay, so I'll step back even a step further and just say what an ETF is, which is essentially a pooled investment fund that really trades on the stock market, just like a stock. So you can buy and sell it all day long, which, by the way, is a critical piece for these leveraged and inverse ETFs that we're about to discuss. And they essentially they hold their basket that hold a bunch of different assets or securities like stocks or bonds or commodities. Now, what is a leveraged or a leveraged inverse ETF? It is essentially an ETF that aims to really amplify the gains of the underlying asset. So if you have a single stock ETF, for example, that holds Tesla, and you have a bull Tesla ETF, it essentially is trying to give you 2 times the performance of a Tesla stock, for example.
So why did leveraged ETFs rise into popularity, rise into fame in 2024, and why are they losing steam this year?
Well, I mean, just as I was just kind of explaining, so obviously the benefit of having a leveraged ETF or even an inverse ETF, which you can kind of think of as a leveraged short ETF, right? You're kind of shorting that underlying asset, is you have the ability to really maximize gains. And in a year where we had the markets going up and up and up, you could amplify some of the gains that we had seen in the market. So if the markets were up 30% over the year, well, why not get 100% of gains in your portfolio? And I think that's part of the reason that we really saw them take off last year. And we now have seen this kind of rise of these leveraged ETFs. There's so many different kinds that are available to investors, and they're investing in a bunch of different stocks now. And I think that's part of the popularity.
And so the cons of this kind of investment, I mean, as we're kind of comparing it to what we've already seen play out in some of the market volatility this year, is it seeming like there's more of a bumpy road ahead for the leveraged ETF community right now?
Yeah. So, I mean, what goes up might also come down. And just as, you have the ability to really amplify gains in these leveraged ETFs, you also have, unfortunately, the ability to amplify your losses. So if you are a part of an ETF that is literally aiming to give you 3 times the returns when that, stock or underlying asset goes up, well, the reverse is also possible, right? If that asset really declines, you might see significant losses on the other side. And that's what we have been seeing, right? So Tesla investors, I kind of mentioned that one. That's just a kind of ETF or leverage ETF that I had in my head. We've seen those folks that have really been invested in that leveraged ETF really suffer huge losses over the last couple of weeks, as we've seen Tesla have major declines this year. Now, I should also mention that leveraged ETFs are not meant to be held for the long term. That's usually what we tell investors, right? You're trying to buy and hold for the long term. Yeah, leveraged and inverse ETFs are really a trader's tool and a trading vehicle. You're meant to be going in and out of this position throughout the day. You're not supposed to be holding it for months or years at a time.
Okay, so that starts to get to my next question, which is what kind of investor should consider adding leveraged ETFs to their portfolio?
Yeah, if you're not someone who has the time or, frankly, I think the technical know-how to sit there all day and watch the market and really watch what's kind of happening in your investment portfolio, then this is not for you. Because then again, like I said, it's great when things are going well and when everything is going up, but it is heartbreaking when things are not going well and you start to see things going down, because then you start to see massive losses. I mean, you could have a leveraged ETF swing in price from $200 a share and then drop all the way to $30 a share. Ouch, like that's really painful for you if that's what you've put all of your money in and that's what you're hoping for to get a lot of gains in your portfolio.
Absolutely. Kristen, great to see you. We'll do this in New York next time. I know you're having fun out there at the conference.
Thanks so much, Brad.
See you. Coming up, everyone, Trump says federal student loans could be managed by the Small Business Administration. We have a panel of experts to explain what that could look like after the break. Let's take a look at the major averages here as we are just about 2 hours into today's trading session. We've got the S&P 500 loaded up here on the screen for you. Right now, we're seeing gains of 1.7% here. The NASDAQ composite adding on 2% during today's trading session. And the Dow Jones Industrial Average, that's up by about 1.3%. All of this as some of the tariff talk is seemingly adding a little bit of relief in that it won't be as wide-ranging as anticipated. We will, though, see how the details play out, and that's going to be important, and we will see exactly how that gets factored into the markets. We know on the onset of some of that tough tariff talk, the CBOE, volatility index, the fear gauge index, that was above 20. In fact, it was above 25 in some instances. Actually, let me get back over to the correct VIX here. That was the VIX of the VIX that we were looking at a moment ago. But there you're seeing exactly where we were within that range of some of the earlier tariff talk. But now we've come below the psychological level of 20. So pressure's easing a little bit, fear gauge index easing a little bit, and that helping for the markets here on the day and some of the activity in positive territory that we've been tracking. This also, as we're tracking the main, let's get over to the NASDAQ 100, the Mag 7s that might be in your portfolio. This is one of the most crowded trades out there, long Mag 7. And taking a look at some of the intraday activity, take a look at these jumps. Amazon right now up by about 2.8%. You're seeing Nvidia higher by 3.7%. Meta, that's up more than 3%. Tesla is adding on a whopping 9% here on the day. So we'll continue to watch to see how that company rebounds. Year to date, though, still in the losses category here. It's down 32% over that period of time. We'll continue to track some of today's gains as we get further along in today's session. Just a few spots of red. Netflix is one of those, though. That is down slightly by about 0.25%. But the run this year to date, it's been adding on about 7.5% over that period of time. So we'll continue to track all of these moving forward throughout the rest of today's trading activity. We'll ride out with a quick look at the 11 S&P 500 sectors, all in positive territory right now, being led by consumer discretionary. Well, President Trump signed an executive order last week declaring his intention to dismantle the Department of Education, saying that federal student loans will be handled by the Small Business Administration.
I've decided that the SBA, the Small Business Administration, headed by Kelly Loeffler, is a terrific person, will handle all of the student loan portfolio. We have a portfolio that's very large, lots of loans, tens of thousands of loans, pretty complicated deal. And that's coming out of the Department of Education immediately.
Here for more on what that plan would look like and whether that would mean any changes for borrowers, I want to bring in Frederick Hess, American Enterprise Institute Director of Education Policy Studies and Senior Fellow, and Julie Margetta Morgan, who is the former Deputy Undersecretary at the Department of Education under President Biden. Thank you both for joining me here. And just to kick off this discussion, exactly what would this mean if the Small Business Administration were to assume some of these tasks from a Department of Education that essentially the president is looking to sunset here? Frederick, I'll start with you.
First off, viewers should know this is all entirely speculative. Right now, there's statute that attaches the student loan operation to the Department of Ed. Either the courts will have to weigh in or Congress will have to change that. If it were to move, it's unclear what it would mean. We have enormous problems right now. Under President Biden, the department failed 3 consecutive audits. The FAFSA form turned into a debacle. $500 billion was shifted from borrowers to taxpayers, and most loans really weren't collected. So right now, the whole student loan situation is a morass. And what it would look like, either whether it stays at the department or hypothetically move to the SBA, who knows?
Julie, I want to get you to weigh in on that too, especially considering the fact that as we're thinking about the number of borrowers out there trying to figure out, even if this is speculative right now, of course there's going to be legal proceedings. Of course there's going to be actions of Congress that will need to come forward as well. As that all settles, what does this mean for borrowers?
Yeah, I think we really have to put this move in the larger context of the student loan program and of America today. So, Donald Trump was elected at a time when Americans are really concerned about the cost of living, and student loans are a big part of that. And we have a student loan program that's run by servicers like Mohila that have proven time and again that they'll put their own bottom line ahead of borrowers, and they'll look to cut corners wherever they can. And so instead of targeting that waste, fraud, and abuse in the program by the student loan servicers, the Trump administration has actually fired the watchdogs who keep an eye on the servicers, and they've put on leave many of the staff who would help you if you had a problem with your loan, both the staff at the Department of Education and at the Consumer Financial Protection Bureau, which has been a key resource for borrowers when they get into trouble. So instead of really addressing the problems at the bottom of the student loan program, the Trump administration is continuing to let these big companies siphon hundreds of millions of dollars out of the program. And then here they come with this suggestion that they'll move the program to the Small Business Administration. And obviously, moving it unilaterally is illegal, but even if they had the legal authority to do this, it would be a disaster for borrowers. The student loan program is the size of Wells Fargo Bank, right? The Small Business Administration just laid off 40% of their staff. There's no way this is a good idea.
Frederick, if we did see more privatization of some of the actions and servicing and obligations that has really fallen upon the Department of Education for so long, what does that look like in a change of experience, a change of who gets qualified even as well? Because now they're looking at credit worthiness for people who are just looking to go and get a higher education and hopefully get paid more over an extended period of time in their career.
So there's a couple things. First off, it's important to keep in mind that we used to run the federal student loan program by guaranteeing private loans up until 2009. We nationalized the student loan operation. It was supposed to help pay for the Affordable Care Act. Instead of helping make taxpayers more than whole. What we have seen, especially again, the last 5 years, was taxpayers $8.5 trillion or more in debt that they had provided mostly to folks who had taken loans to go to graduate school, who then didn't want to repay their loans. So the first thing to keep in mind is that the system we have right now is not working. It's not being implemented as legislated. My colleague spoke about Mohela, for instance. One of the unfortunate realities of the last 4 years was that the Federal Department of Education just smacked the living heck out of the loan servicers and the folks who were charged with actually making sure that loans were collected. And then when the system crashed, turned around and scapegoated them for not doing work that the department had made impossible to do. Is the SBA the right place to park this thing? It's unclear. The reality is the system we have right now isn't working. But more important for folks watching who are borrowers is none of this is likely to have nearly as direct an impact on them as the decisions Congress is going to make in the reconciliation legislation this spring and summer. Those are actually what's going to be, those are what are going to involve overhauling some of the ways in which the system actually works. And whether that works out well or poorly is really going to be the most significant thing on the horizon.
Julie, just last question to you. The system as we have it right now is extremely expensive. The costs of college education, higher education, far outpace that of wage growth. And with that in mind, are there any advancements that we're hearing at this juncture to rectify what is the very core issue, which President Trump, as you mentioned, was elected at a time where a lot of Americans were saying everything is so expensive. How do we bring down some of these costs? And this is a family financial decision for many households who can't afford it.
Yeah, and I completely agree with my colleague here that the program is broken. And Americans agree that affordability in higher education right now is broken. And that is where the Trump administration should be putting its efforts. And instead, what we're seeing them do is create chaos in both the student loan program and in the provision of federal funding for higher education overall. Colleges are scrambling, borrowers are scrambling to understand what these changes are going to mean. And meanwhile, they're waiting for a solution from Donald Trump, who was elected to help address the cost of living in America, about what exactly he's going to do to bring down the cost of college and to make people less dependent on student loans.
Frederick and Julie, thank you both so much for taking the time here with us today. We're going to continue to follow the developments here and perhaps continue the conversation as well in the future.
Thanks.
Thanks.
Coming up, why a recession could actually be a good thing for the housing market. That's next on Wealth. Evercore ISI downgrading Lennar to inline from outperform following the home builders' weaker than expected guidance for the second quarter. Yahoo Finance's Josh Lipton joins me now with a closer look at the home builders and the state of the housing market. Hey, Josh.
Well, Brad, we recently did get that bit of relatively good news on the housing market. Remember, while there hasn't been a dramatic change in mortgage rates, home sales rose 4.2% in February compared to a month earlier to a seasonally adjusted annual rate of 4.26 million. That was according to the National Association of Realtors, and that was better than what economists had expected. Now, is that sustainable? Well, some economists we know are skeptical. David Rosenberg of Rosenberg Research, for example, says affordability remains an ongoing constraint on sales. Rosenberg telling his clients between prices still being at punishingly high levels relative to income and mortgage rates remaining stubbornly near the 7% level, this is something to watch. Now, investors will be getting more important insight into our housing market from the home builders this week. If you look at that sector as tracked by the iShares U.S. Home Construction ETF, it is in the red, both so far in 2025 and over the past 12 months. Lennar, remember, reported results late last week and did not impress investors. Its guidance for second quarter margins came in below expectations, according to Bloomberg, and it offered new guidance for Q2 orders that missed estimates. Now, next on deck, KB Home, which will report its financial results after the market close today. The team at B of A recently did publish a new note on the state of the U.S. housing market. Bottom line, they told clients that demand remains muted nationally. Incentive levels remain elevated, a margin headwind for the builders. They also note policy risk, specifically that tariff and immigration concerns are top of mind, though they emphasize no major disruptions yet on those fronts. Their 2025 year-end mortgage rate base case forecast, 6.25%. As for stock picks, they do have buys on Pulte and Toll Brothers, but do remain neutral on D.R. Horton, KB Home, and Lennar. Brad, back to you.
Josh, thanks so much for the breakdown on it. Sticking with the housing market, the S&P 500 and the NASDAQ both entered correction territory this month. Paired with a weaker economic data backdrop, it sparked concerns about a possible recession. But according to a new study from First American, there could be a silver lining to a contracting economy here, and it could make housing more affordable for buyers who have been facing mortgage rates between 7 and 6%. Here with more and this breakdown, we've got our own Danny Romero. All right, so what do past recessions tell us about the housing market?
So history has shown us that the housing market can be resilient during challenging times. There's new analysis from First American that shows us that past recessions have varying effects on home sales. So for example, in 2020, home sales fell dramatically due to the pandemic shutdown, but the drop in sales was really short-lived. The housing market quickly recovered during this time due to the record low mortgage rates and also the strong demand. The housing market's performance really relies on two factors. That is the cause of the recession and also the Federal Reserve's moves. So the Fed usually lowers mortgage interest rates when the economy slows down to stimulate growth. And as a result, mortgage rates could decline, helping the housing activity, right? So if we take a look at where we are today, mortgage rates have drifted lower from their highs of 7%, but they remain steady around that 6.6%. And economists at Wells Fargo expect that mortgage rates will remain at their current levels due to the economic uncertainty that is happening. But the Fed did signal 2 rate cuts this year. So we'll have to wait and see how the market really responds to these dynamics that are happening right now.
So would a recession be good, dare I say, for the housing market? Just not necessarily mean a crash.
Lower rates will stimulate the housing market. It'll bring buyers and sellers that have been really hesitant back into the market. And overall, Brad, the housing market has been sluggish. We've seen ups and downs, and so this would really move the needle here.
All right, Danny, we're going to continue to track this closely. Hopefully we don't need a recession in order for the housing market to be stimulated, but of course we're continuing to monitor all the data that spells out the trends. Thanks so much. In 2024, natural disasters caused more than $182 billion in damage to homes and other infrastructure in the U.S., with 27 events exceeding $1 billion in losses. That is the second highest reading of $1 billion disaster events on record. With natural disasters affecting people with more frequency and intensity, Schwab is out with a financial checklist to help people navigate these events. And here to dig in, we've got Rob Williams, who is the Managing Director of Financial Planning at Schwab Center for Financial Research. Rob, good to have you here with us. So let's start with what you can do during and immediately after a natural disaster.
Yeah, I mean, the first is just to accept it's very stressful. It's emotional. As you said, we've seen a big pickup in the natural disasters. It's in the news. We see it. It's very high profile. It doesn't mean it's going to happen to you, but if it does, finances are math and emotions combined. So that's really our first tip, is to accept it's stressful. And it helps to have a plan in place to sort of move on, beyond that, but deal with those emotions first, then simplify. It really helps to have those simple steps in place in advance, even if it's a minor emergency or a disaster. I mean, your house burning down, clearly that's a major one. But we all face financial stress, et cetera. And just accepting that. These are emotional things. That's really the first tip that I tend to suggest. That's okay. We're human. We can deal with the details after you get out of the situation, but that's really the first step to take.
So let's say, and if you do have the ability to know a month out from the event what you should do, what precautions you should take, or what precautions you should have taken regardless of whether or not there is an event that's brewing.
Whatever the financial issue is, where it's a stress, a down market, disaster, your home burning down, a car repair, preparing in advance is really the critical thing. It's too late to prepare afterwards. There's really simple steps you can take in personal financial hygiene to be ready for that math side of it. And that's really the first step. Once you get there, it can be a little bit more difficult. There's things you can do still, but planning in advance is really the key step. And they're really simple steps, and that's one of the reasons why we created the checklist.
And so that's the preparedness side, but then, of course, you have the reactionary side that is inevitable. What moves can you make about a half a year, 6 months after a natural disaster?
One of the first things you can have in place is an emergency fund. And I know it sounds a little bit like, it's just sort of a simple step, but having 3 to 6 months or even up to 12 months if you're, say, in retirement, don't have a job, in an emergency fund gives you that financial cushion in place. So that's really step one. Have that fund, and then when you need it, use it. You'll have time to replenish it later, but a key with that is it can keep you from tapping things like your 401k, your retirement accounts, panicking and selling other assets, et cetera, in a down market if you have other investments. So that emergency fund first. The next is going to come to insurance and making sure, again, ahead of time you have the right policies in place. There are a lot of natural disasters that aren't really covered by traditional policies, and making sure you've got the flood protection in California, earthquake, things like that, being on top of the insurance policies. And then the third is really have a network of friends and family. That also sounds obvious, but finding housing, all of these things, it requires having a network, not just the financial means to help get through some of the emotions, but also the financial burdens as well.
How long should you be expecting dispersal of your claim to actually take time to review and then ultimately getting that dispersal?
Longer than you would think, and that's really key. Is you're not going to be getting funds. Some insurers will provide some cushion or some relief quickly, but these things do take time. If you have a mortgage, other things, you can request mortgage relief and have a pause in payments and those sorts of things. But patience with this is really key. Also, if you're starting to do construction, there is contractors, folks out there who might be looking to take advantage of disasters, being very patient, with that and not rushing into financial decisions in these periods of stress, is really a critical point as well.
Rob, thanks so much for taking the time and breaking down this checklist for us. Really appreciate it.
Thank you.
We've got much more on wealth after the break. You're watching Yahoo Finance. A programming note: on today's episode of Financial Freestyle, host Ross Mack spoke with a finance entrepreneur known for making personal finance and investing accessible to millions. Take a listen.
I say 5 to 15% of your total portfolio should be invested into sort of these like diversified, ways to earn more money while also weathering a potential storm. And so when it comes to investing and what to buy, it's as simple as that. A lot of people make the mistake of, some guy on the internet told me I should go buy this crazy stock. He says it's going to go to 100 and it's at 4 cents right now. I'm going to become a billionaire. Man, I've made those mistakes. I've bought the penny stocks. I've lost the money, and I've realized that's not investing. That's gambling. Yeah. I'm an investor. I don't like to gamble, and I'd encourage everyone to have that same mentality in 2025.
To catch the latest episode of Financial Freestyle, tune in every Monday at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. We're wrapping up the first quarter of the year, and in honor of spring, we're spending the whole week talking about spring cleaning your finances. The moves you can make today to take a good financial path for the rest of the year. Today, we're talking about your budget, and here with more, we've got Michaela Alaka, who is the founder of Break Your Budget. Michaela, great to have you back here with us. You have some ideas for tracking your first quarter spend and using it to inform the rest of the year. Break that down for us.
Absolutely, and thanks for having me. So my best recommendation for getting started with auditing and spring cleaning your finances is to take a financial snapshot. And what this is going to do is show you how much money you are spending on essential things and non-essential things every month, with ultimately the goal to aggregate all of your expenses for the quarter. Those quarterly totals are going to surprise you. And when you look at them, what are you spending on your housing? What are you spending on your other essential living costs? And then what are you spending on that non-essential stuff? Maybe shopping or going out, or, those small leaks in your budget. And are there areas where you may not be feeling the ROI on that spend? The goal is to make sure that the money you're spending is actually adding value. So when you look at these totals, you can see maybe some of these monthly expenses that I'm not really thinking about are actually derailing my plans.
I'm already preparing myself for a massive yikes when I take a look at mine. But it's a good activity and exercise that you're suggesting here, and I'll report back on my findings for myself. But I'm thinking about some subscriptions here as well that people might have. How do you know if you have too many or if they are actually useful to you?
Absolutely. So when it comes to subscriptions, really the goal is to make sure that the subscriptions you're paying for are subscriptions that you're actually using. So what you need to do is set some thresholds for yourself, and those thresholds are going to look a little bit different for you based off of what type of subscription it is. So when I think of subscriptions, the very first thing that comes to mind is streaming subscriptions. And, we all have multiple streaming subscriptions, whether it be Netflix or Peacock or HBO Max. Which ones are you actually using multiple times a week? I actually just canceled one of mine because I realized I'm only using this maybe once or twice a month. Like, I'm not actually getting the ROI there. So for each subscription that you have, start counting how many times every week are you actually using it. And if you're not using it, 4 to 5 times a week, it may be something that you can cut out of your budget. And you can always go back and add it back in if you find that you're missing it.
How can you be more cadenced as well in making sure that this is part of, once you've gone through the assessment of kind of doing the spring cleaning and looking back on what you spent in Q1 and using that for your forecasting for the future, how can you be more cadenced and bake it into a routine?
Absolutely. So there are 2 things that I recommend here. First would be to start following either a weekly or a bi-weekly routine where you are tracking your expenses and you're making small adjustments to your budget. The real purpose of this is actually twofold. So first, it's going to help you audit your expenses and cut those unnecessary expenses on a regular basis anyways. But the other thing it's going to help you with is understanding your cash flow. And when you understand your cash flow, you can make more informed and more confident financial decisions. You can, deploy money towards your savings or your investments or increase your retirement contributions. And then you can actually make sure, again, the money that you are spending is actually adding value to your life long term instead of just ever so slightly leaking out of your budget every single month. Because ultimately, when it comes to budgeting, it's a really agile practice. It's supposed to be iterative. And where we lose a lot of people is, they think it's this one and done thing where if I go over in one area or maybe something in my life pops up, I'm just going to throw caution to the wind and I'm not going to look at it again. But ultimately, your budget is supposed to change with you as your life changes. And I don't know about you, but my life is changing pretty regularly. So I'm always making changes to my budget.
Just lastly, while we have you here, what if you take a look at what's coming in and out and you say, I need to make sure that a little more is coming in? What are some of the easy sources that you could start to tap and generate even more income?
Absolutely. So the first thing that comes to mind, there are 2 cash back or, ways to increase your cash flow pretty quickly. One would be to make sure you have a high yield savings account for your savings. So with a high yield savings account, you can earn some extra cash on your savings already through earning higher interest on the money that's in that account. So that's a really quick way to start adding, maybe $50 to $100 a month, depending on how much money you have in that account. The other thing I would recommend you do is use cash back tools. The first that comes to mind for me is Rakuten. So for all of the shopping that you're already doing, when you use a tool like Rakuten, which you can just install with like your Google Chrome extension or via the app on your phone, you can earn cash back on the purchases you're already making, and they'll actually send you a quarterly check. And you can use that money for whatever you want. It's money that you are spending anyways, and you're just earning a little bit of extra on top of it.
Some great advice there, Michaela. Great to see you. Thanks so much for joining.
Thank you.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You could stay tuned for Market Domination. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.